Hello, this is John Zolaitis. I am the founder of Covatus Capital, and I recently returned from the Valuex Middle East conference in Dubai, where I gave two presentations, one of which I'm going to repeat here, which addresses short selling from a value investor standpoint. My agenda today is to define very briefly how I define value investing. Secondly, we'll talk about why short selling is different or what incremental approach and thinking is required. I'll then go through our process for evaluating equities, and I will finish up with some examples of short selling ideas that worked or didn't work. Before I get going, here are my disclosures. Please read these. This is not an advertisement, nor is it investment advice, and you should get investment advice from your financial advisor. So I started with a survey of the audience, asking these questions about whether people shorted and what they thought about it. I encourage you to answer these questions for yourself. But as an FYI, in general, the participants were not particularly active from a short selling perspective. What's value investing? In our view, value investing first starts by evaluating the value of a security. And how do we define the value of an equity? Well, I believe it's defined by a company's future earnings and cash flows that are discounted by the time it's going to take to achieve those earnings and cash flows, as well as the risk profile of the business in the industry, and then adjusted for the company's balance sheet and any special assets it might have, such as patents or brand. Value investing, among other things, is to buy equities that are trading at an appropriate or attractive discount to the intrinsic value as I just defined in the previous slide. And of course, you do want those stocks that you buy to at some point go up, which is another component of the in value investing activity. Can value investors also be short sellers? This is actually a question of debate. There are many value investors that believe that you should not be short sellers. There's also a kind of a dogma that there's an asymmetric risk reward in shorting. I think this is actually wrong in important respects, but I'm not going to get into all that today. Before I get started, ask yourself what you think is the best possible short. What criteria would make something the best short? It's a short that you never have to cover. Now, why would you never have to cover it? Well, if you short a stock and it goes to zero, the company declares bankruptcy, it's possible that you may never have to cover. Why is this interesting? Because then you don't have to ever pay the taxes on the capital gain that you achieve by shorting the stock. And another scenario would be a radically overvalued business that gets significantly re-rated lower, and there's just like no possibility that it could ever go up again. And so you can just leave it on your books and maintain the cash that you received from borrowing and selling the stock. These here are horos or horai, which are ancient Greek boundary markers. These two come from near Athens. They're from the 6th century. And there was this guy, Solon, who got irritated by all of these boundary markers, which in particular delineated public versus private lands. And he organized these to be removed, which paved the way for democracy. But what I want you to think about is these boundaries being between your approach to investing and the idea of short selling. And I want you to channel your inter solon and get rid of these boundaries, can value investors get better at their activity by developing a short selling discipline? I mean, I think so, yes. That's why I'm doing this presentation. Okay, some reasons you should consider having a short selling discipline. First, as I talked about, it's going to develop an alternative thinking process from an investment standpoint. It will also help you understand why some opportunities come about. It certainly doesn't hurt to know what would cause shorts to cover. And you should stress test your long ideas with a process from a short perspective to see if you got it wrong or see how you might have it wrong. It's also a way just to make money from overpriced or stupid stocks. You can use it also to hedge exposure and hedge exposure both on a market basis and individual stock basis. And lastly, it's fun to profit from the dash dreams of others. Okay, what do you need to short sell that you don't need to evaluate equities as a value investor? So I'll answer that by talking about, again, value investing. When you're looking at a stock from a value perspective, you're evaluating what you think the equity is worth or the intrinsic value is relative to your internal view that you've developed through security analysis and looking at the industry and modeling the business out, et cetera. You can actually just not care why the market is valuing the stock below what you believe the intrinsic value is. It's more about what you think the value is. On the other hand, when you short sell, you need to find a catalyst that's going to make the stock go down. And it is much more important, in my opinion, to evaluate the stock relative to the external view, the view of others to the company. I don't think you can really short sell without trying to understand why the market is valuing the stock the way it is. And in this sense, I think short selling is not simply the inverse of value investing. You need to understand the embedded expectations in the stock and answer the question, what is going to make people sell? Is there a process to do that? Yes, I'm going to talk through about our process. But before I get to that, I'm just going to kind of list types of shorts. So you could have macro shorts based on the overall economy. You could look for businesses that are losing market share. We call that competitive intrusion. Structural shorts, shorts that are based on a product cycle running out of speed. There are frauds. There are companies that are poor capital allocators. We could look for just relative underperformers to our long ideas. Tactical shorts, that's more trading oriented. There's expectation shorts where the business might be fine, but you think what the street's looking for is just unrealistic. Pure valuation shorts where a business is overvalued on a significant basis relative to what you think the value is. There's also more sophisticated shorts. I can't really get into these where the balance sheet is impaired. You've got an inventory cycle. You might see some forced selling based on things that are happening from just a supply demand standpoint. There's arbitrage shorts. There's other kinds of shorts. I only really do structural shorts. And the reason for that is that I just don't have an edge. A lot of these other things, they can be excellent. Some people are fantastic at discovering fraud or evaluating things on the balance sheet. That's just not where we are good. So I'm going to talk a little bit more about our approach. So this is what I look for when we're trying to determine whether a stock is a short. And our long ideas are using very similar criteria as well. So first and most important thing is that we believe that you need to find a stock that has downside to existing street estimates. So that's the main thing we're trying to find. That's the number one criteria. It's really hard to short a stock that you don't think is going to miss numbers. Typically, companies miss numbers because they have poor ROIC or a negative inflection in ROIC, deteriorating ROIC. That tends to accompany with contracting EBIT margins, decelerating growth, and then lastly, unfavorable valuation. So we don't start with valuation. That is the last criteria that we look at. To determine whether companies fit that process that we just, or hit those criteria that we just outlined, we have a process which is based on unit level economic analysis. And this is really based on our specialty or specialization in the retail and restaurant industries, where you have lots of individual components that you can evaluate separately. But it could also work for companies that operate, for example, hotels, car washes, fitness gyms, anything where there are separately identifiable capital components invested in the business, which allows us to look at the company by separating these pieces out into the components parts and then solving for return on invested capital. So that's the first part. We find the businesses that have these structures and we solve for unit level return on invested capital. The second piece is that we then have a battery of tests for evaluating unit level ROIC. We do a quality screen, which is primarily to compare it to a peer group or other potential companies with a similar structure. We then separate the stores, restaurants, gyms, whatever they might be, into cohorts based on when they've been open. We look at trends within ROIC. Is it getting better or getting worse? And one thing that we think is quite important is to look at what we call return on incremental invested capital. So how are the most recently open stores or restaurants for a business doing? What is the return profile of the most recently deployed dollar into the business? Is it better or worse than the existing business? We then take the output of this process in this battery of tests, and we use this more nuanced, deeper evaluation of the business as the basis of a forecasting tool, which we use to test consensus forecasts. And what we're trying to solve for here are cases where the estimates are very different from what our model says is likely to occur. Once that happens, we try to explain why this might be the case. And therefore, we're looking for an alternative narrative to the consensus or the street or the company's discussion of what's going on that explains what's happening from a unit level economic standpoint and helps to frame our expected deviance from consensus expectations. Lastly, we also have a unit level valuation tool that we use. So here are some of the short narratives that we use when we're looking to explain why businesses are getting generally worse. So for example, new market entry or business growing too fast, maybe they're getting saturated, competitive intrusion, weakness in new product trends, slowing product cycles, fads. We look for customer losses and additions. We look for guidance which is misaligned with an environment which has changed, unfavorable pricing or cost cutting, which might be unsustainable. Cash burn and leverage, that's more about growth relative to the quality of the returns that companies are getting. And then we look for businesses that are destroying value by deploying capital into low ROIC return projects or bad acquisitions. and business models that won't scale. How can you get in trouble? Well, again, our approach is fundamental, bottoms up, company specific. Not claiming this is the only approach. There are other approaches, but from our personal experience, where I get into trouble is if you make your short call based on a macro, if you short valuation on valuation basis with no catalyst. We try to avoid shorting really high quality companies or love names, at least, or in this case, you need a really high bar for your thesis. We avoid battleground names. They just always seem to take longer to play out than your patience, which increases the possibility that you'll just cover at a loss. Also try to avoid stocks that have already gone down substantially. Sometimes it can be tempting to think that they'll just keep going down, but frequently it's priced in then. Also high short interest, thin float, that combination. And the most controversial, or one where I sometimes get in trouble, are small companies with open-ended growth, businesses that can really grow for a long time. They tend to trade at really high multiples based on that long-term growth outlook. On the other hand, these stocks can be excellent shorts if you get it right. So we do spend a lot of time on that scenario, but we have a high bar for wanting to short those names. In addition, you need a covering discipline. So when you're going to cover a short, number one reason, let's say the short works, is the downward revision to cycle to earnings is over. So if a business, for example, is anticipated to earn $3, you think they're going to earn 50 cents. When the estimates get reset to 25 cents, you should cover, because now you believe that the earnings might actually be higher than street consensus. As soon as you think those earnings are no longer going down, your short case is either busted or it worked. A second reason to cover might be valuation. If you think a stock's just gotten too cheap to no longer allow you multiple contraction. And third reason is to be wary of capital markets in activity in the space. This could be mergers and acquisitions, could be LBOs. Does the LBO math work on that business? And are there activists that are likely to come in? On the other hand, sometimes you're wrong on shorts, or frequently can be wrong on shorts. If you're not getting results that are consistent with your thesis and they're not being expressed in terms of downside to estimates, you might be wrong, or you might be too early and you might want to come back later. So if they're beating your internal expectations, they're beating street expectations, rather than missing, you're wrong, move on, come back later. Or, just something changes, like they make an acquisition that's accretive, or something else happens, the environment changes, new management comes in, anything where your thesis is no longer valid. So some of the people at the conference asked me, why I like to short. And my response was, I'm just kind of naturally skeptical. Before I went into finance, I pursued a PhD in philosophy. I do have over 20 years experience shorting or publishing short ideas, some really great shorts, and many really bad ones as well. Again, there are probably many people who are better at shorting out there than I am, but hopefully you'll still get some value out of this. I've shorted one name that went to zero personally, and I had one fraud call in 20 years, just to show you how rare those might be. Of course, I'm not spending 100% of my time shorting. I've got a lot of other things going on as well. So we provide advice to professional money managers, hedge fund managers, pension fund managers, mutual fund managers, and I've now accumulated 5 years of results. Over the 5 years, the average long idea that we have provided has returned about 46%, and the average short idea has gone up about 5%. So obviously, I would be much happier if there were a minus sign in front of the average short, but I think you need to take into account that the market has also gone up about 50% over this period. And the spread between our long calls and our short calls is about 40 percentage points over 5 years, which I believe really shows that our approach and our discipline is creating alpha by separating winners from losers. Okay, so I'm going to go through 3 ideas that worked and 1 idea that didn't work as a lesson. The first one is this company called Habit Burger. It's now gone private. These ideas are from the far off past, and I have plenty of active ideas right now, but just in terms of talking about process, in this case, small restaurant company was opening up a lot of stores. We looked at traffic, pricing, labor, and occupancy costs, and we compared that to what we thought to consensus estimates. We believed the consensus estimates were much too high. And in fact, Street cut their numbers from a quarter to 11 cents, and the stock fell 25% in 1 day. Another company, this company is still public, Red Robin's, another restaurant company. We looked at cost headwinds embedded in the business, and we also saw that the company was cutting labor from its stores. And we compared that to what the Street thought was going to happen. And we said, hey, they could miss by $1 per share. And sure enough, in October 2017, the Street was looking for $3.29. And then they cut their numbers to $2.63 in November, and the stock fell 29% in 1 day. Here's a different idea. It took a little bit longer to play out. This company, Dollarama, which is an excellent retailer up in Canada, it's a discount retailer, had been a great performer for many, many years. It was trading at a very high multiple. And what we saw was that the transactions at their older stores had turned negative, and we believed that they'd taken prices up too much. We also saw that new stores were coming in at lower revenue levels, which, remember, is consistent with our approach on unit level economics and finding negative inflections. There were some other environmental things happening. We had to have this call out there for about a year before it finally worked, and the stock went down about 20% in 2 days. And then lastly, just, to be fair, there's lots of things that can go wrong when you're shorting. Boot Barn is a small retailer of footwear, of Western style boots, and also workwear boots and some apparel. It's an excellent company. And during COVID, the stock got creamed because everything got hit. And it had bounced off of its lows. And we thought that, hey, if the lockdowns continue, there will be fewer people working. The work component of their business will suffer. And so we thought that we made a short call in June of 2020. But what really happened was that the environment remained quite strong, and the stock recovered along with the overall market. And the stock doubled before we gave up on our short call, which just goes to prove that really this was just a stealth macro call. And as I pointed out earlier, should not make calls on macro. So continue to learn the same lessons over and over again. That's the end of the presentation. I hope you enjoyed it. If you have experience shorting or questioning or have questions, please put them in the comments and I will try to respond. Thanks a lot.